everything you'd look for if you're a checkpoint investor is certainly looking good, with the probable exception of the competitive marketplace.
It's not surprising that, Klaviyo has just turned a profit in the last year, and now it's like, all right, well, now we can IPO, because I think that's what investors expect now. I don't think the excitement would be there for an unprofitable company coming to the markets.
When I realize, or I'm told, that something was generated with AI, no matter how impressive it is as a product, I devalue it.
I just want to give a quick word from our friends and sponsors at Vodafone Business. I used to think of Vodafone Business as only a reliable provider of mobile and broadband needs, but they're really stepping up to help Irish businesses grow and flourish in an increasingly digital world. So they now offer a whole array of digital apps, from productivity tools and security solutions to IT support and even website builders. More recently, Vodafone have launched their VHub digital advisory service. With its new service, Irish businesses of all sizes can get free one-to-one digital support and advice tailored to their business by simply booking a call with one of the VHub digital experts on the Vodafone Business website. Search Vodafone VHub for more information. Emmet, how are you? Welcome to another episode of Stock Club.
Thanks, Mike. Good to see you. How are things in France?
Things are mighty in France. Do you want to start the episode with a fun fact of the day?
Me? A fun
fact? I'm not putting you on the spot. Would you like to hear one?
I'd love to hear one. I was kind of, whoa, that's real pull the gun dance. I'm like, it takes 150 million Smarties to fill a bus. Go on, hit me.
So I'm not sure if this has ever been discussed on Stock Club, but I think we discussed it in MyWallSt at one point. So the founder of Duolingo invented the CAPTCHA, the I'm not a robot. Pick the 3 photos with the motorbike in it.
Oh, I mean, seriously, humanity owes this man a favor for Duolingo, and we owe him revenge for that. We really do. And I did know that fact, because we did Stock Club. We spent some time talking about Duolingo and Stock Club a couple of years ago. You weren't on this particular show, and it turned into a conversation about how impossible it is to actually get those CAPTCHAs first shot. I mean, it's not an easy undertaking. It's like have all the pictures with a staircase, and they're blurred. You're like, I can't see anything.
Well, it starts getting existential. You're like, is the base of the staircase, or is it just the stairs?
Yes, exactly. Or I see the handle of a bike. Does that constitute a bike? At what point are we fully talking about a bike? Yeah, I have to say the cap. But are they still around? Do you ever see
it only reminded me because I was signing into StreamYard today, and it popped up. Yeah.
It was on again. Oh, I'm sorry to hear that. I thought the latest version was you just clicked on a field, a little button that says I'm not a human, and because it knows from the motion of the mouse, it kind of saves you the misery of having to choose, an elephant out of a matrix.
Yeah, so maybe Duolingo was his gift after giving everyone the horrors of the CAPTCHA.
He owes us one. I'm on my 800-day streak on French today, so I'm really glad you raised Duolingo. It allows me to just kind of mention a casual flex there. I've done 800 days. I mean, I haven't done 800 days of anything in a row except maybe breathe. I'm so impressed with myself.
Yeah, is that now a true streak, or did you get?
It's a true streak.
True streak every day.
Every single day, you name it, and I've had some narrow escapes. But yeah,
I was about to say, do you ever get like wake up in cold sweats at 11:58 p.m. and be like, I have to go on Duolingo right now?
Yes.
Okay, let's get into the show. So IPO season is kind of kicking off really this September. We talked at length about ARM's blockbuster IPO, and since then have come the public debuts of the grocery delivery app Instacart and marketing company Klaviyo, which you're going to discuss on today's show. So they were Tuesday and Wednesday of last week, one after the other. So Emmet, do you want to kick us off with Klaviyo, a company I know very little about? So what does it do, first of all?
Yeah, I have to admit, I hadn't heard of the business until I saw it was lined up for IPO and watched it on the day. But basically, it's a marketing automation platform that helps businesses acquire and retain and grow their customers through things we're all used to, like SMS marketing. And they have this big toolbox of features to help businesses to effectively create and send emails that are more effective, well, they say, than other platforms. So they do things like email segmentation, email automation, so you can lock and load an email to send at a prescribed time, or SMS marketing, which I think certainly in my part of the world and our part of the world, I think is in SMS marketing. I've barely been hit with SMS marketing, a handful of
No.
a year, thankfully, and then all the reporting and analytics that goes with it. And they do a load of other stuff like CRM, customer relationship management tools, education. They just have a toolbox for digital businesses. And apparently, and this is what really surprised me, it's one of the more popular platforms for e-commerce, which is a very old world term, and it has 130,000 paying customers. And I can't believe it's grown the way it has, because it has a load of competitors like MailChimp, OmniSend, HubSpot, Intercom.
No, I was about to say, should we know it ourselves?
Yeah,
How many email clients have we gone through?
yeah. There's Adobe Marketo. We've gone through so many of them, and so for me, it seems like a very, very crowded marketplace. So only about 9 years ago, when MyWallSt had just started, I remember uh, looking up Urban Airship, which was a business at the time for doing exactly what I just described. And then John, my co-founder, and I were in New York, and there was this giant billboard, like one of these multi-story, multi-building billboards for Urban Airship, which up until that moment I thought was a bit of a niche business, and the business is now called Airshop. So there's our Airship, I mean to say, and there you go. It's another competitor. And my point is that this is not a new industry, and Klaviyo are not in a monopoly. They're not even in a duopoly or triopoly or quadopoly or sankopoly,
Quintuple.
quintuple. Like this to me is like, I was quite surprised at that this business suddenly had its moment in the spotlight, and it has some very nice numbers too.
Yeah. So, well, talk me to the IPO first. How did it go for them?
Yeah, well, they priced it. They priced their shares at $30 a share, and they released just over 19 million shares into the wild for normal folks like you and me to buy, which basically valued the company at just over $9 billion on a fully diluted basis, and it raised about $345 million in cash for the company's bank account. So that's the kind of top line figures. And I think what's particularly interesting is that Shopify owns about 11% of Klaviyo shares. It invested
Yeah.
yeah, like it
So
invested $100 million
this
last
is
year.
actually where I first heard about it, was Shopify. Is it Shopify Ventures they call it? Their private market arm.
Yeah, I mean, this is really, that $100 million investment is a testament to their, I suppose, intertwined business models as anything else. And apparently, 78% of Clivo's annualized recurring revenue by the end of last year was generated by Shopify clients. So there's no
Okay.
doubt.
Yeah.
Yeah. So Shopify really is, if you like, the parent. And if we were doing a strategic analysis of Clivo, and we've been doing a lot of talk about this in recent times as we tune our Nexus model, it's having a single, like Porter's five forces, where you have the bargaining power of a single customer. Well, Shopify is an ally. It owns $100 million as it was in the business, or 11% of the business. So you have to suspect that Shopify's relationship has absolutely driven interest in the business and its IPO. And in fact, I'm quite surprised that Shopify didn't just fully acquire it, because seems to be, I wouldn't say indispensable part of Shopify's offering, but certainly a well integrated part. So they were interested enough to buy 11% a year ago, but they allowed it go IPO, if you will, or the strategic direction they took was IPO. So and we've seen this kind of behavior before.
Yeah, it reminds me of a business we talked about a while back, Global E. Do you remember that? I think
Yes, I remember.
Shopify was a big investor there as well. So it's clearly a tactic from them where they get their hooks in across the industry, and I think with providers or people they work closely with. So clearly, and if you think about it, if you're saying Shopify is driving that much business to, is it Klaviyo or Klaviyo?
Well, the way I've pronounced it is Klaviyo,
Klaviyo.
but I'd have to
Um,
speak to the founder to get that kind of
Yeah,
tested.
it probably brings them a bit of solace too, in the fact
Mm.
that you're relying so much on a customer, but now it's not just a customer, it's a part owner as well. So its interests are tied to yours instead of them going off investing in competitor, maybe ditching you, or even producing your own, producing something similar in house, which they have the
Yeah.
scale and resources to do. So I think the fact that they own a piece must
Mm.
give Klaviyo a great peace of mind, but also means that Shopify are kind of in tandem with them instead of potentially conflicting. So I think that's very important
Yeah.
for them.
Yeah. That's a good point.
All right, so you mentioned the numbers. Talk to me there.
Well, I was really surprised because revenue has just grown in the face of the competition it has over and over, quarter after quarter. There isn't a single quarter where revenue hasn't just smashed the last quarter, not just the same quarter a year ago. So Q2, which ended in January, March, April, May, June. Thank you. Ended in June. They brought in $585 million in revenue, which was 56.5% growth on the same quarter a year ago. And as I mentioned, 130,000 customers at the end of June. So this is a business that has the momentum we like to see in a business. And clearly, when you take that momentum, when you take the fact that it's profitable, we're now talking about a digital business that has swung from being lossy quarter after quarter after quarter. It came in with a net income of just nearly $11 million, which is a really nice turnaround from a loss of just over $1 million. $11 million, I mean, say, in the preceding year. So everything you'd look for if you're a checkpoint investor is certainly looking good, with the probable exception of the competitive marketplace. But again, back to your point, Mike, Spotify is the parent there. And if you like, or I don't want to say the sponsor, they don't see themselves as the sponsor or the parent, but they're certainly the big sister, the big brother. They're looking out for this business, and clearly have chosen this as the preferred partner, if you like, of all things email and text and everything in between.
Yeah, it's interesting you talk about profitability there because we're going to get into Instacart too. And I'd say it's a prerequisite now if you want to go public for those private
Yeah,
companies. And it's not surprising that, Klaviyo has just turned a profit in the last year. And now it's like, all right, well, now we can IPO because I think that's what investors expect now. And I don't think the excitement there would be there for an unprofitable company coming to the markets.
completely. It's unbelievable that Instacart and Klaviyo listed within a couple of days of each other. The kind of dynamics of their business are very similar. They both came in onto the market at more or less the same market cap, the same size,
Same
very
market
different
cap
businesses.
and same share price. They both listed at $30.
Really?
30
Oh,
bucks,
I
and it
didn't
was
notice that.
around 9 billion. It just turned a profit last year. It's mad, actually, the similarities. And I don't think that's by accident. I think it's the same reasoning that
Right.
if you want to go public now, you need to tick these boxes. So
Yeah.
yeah.
Do you know what that reminds me of, Mike? About 20 years ago, Cisco, the routers and gooters guys from San Francisco, they had a market cap. I don't recall what it was, but let's just call it $20 billion. And the food delivery logistics company, Cisco, spelt SY uh, SYSCO, I think, or
Yeah,
yeah, it
yeah.
was a similar spelling. They're the guys who make sure that a lettuce that's grown in Iowa is on a restaurant table in New York same day. It was also on one day the exact same market cap. Both of them had a CEO called John Chambers. Both of them had increased revenue by 11% quarter on quarter. Both of them bumped into each other, the two John Chambers, at a convention. And it was on Fortune magazine. I say I'm going back at least 20 years, did a piece on this unbelievable coincidence of the
That's
two Ciscos.
bizarre. Yeah.
Yeah.
That was probably when the rapper Cisco was at his prime as well. Do you know him? No? You ever heard of the Thong
uh,
song?
oh, I do. Is that his name? Is that
That's
Cisco?
Cisco, yeah. So
Oh,
there's
yeah.
there's the triumvirate there.
There we
Uh,
go.
all right, I'm gonna get into Instacart now, and we just mentioned the similarities.
Yeah.
Um, so yeah, I think it's interesting to talk about this because Instacart probably gets a lot more attention than something like Klaviyo. Like me and you had never really heard about it
Yeah.
before it went
Yeah.
public and we started talking about it. Whereas Instacart, I think a lot of our listeners will be familiar with the product if they're in the States, but even not so, even just hearing the name thrown around, I think it was kind of meant to go public for a very long time, and it was humming back and forth and
Mm.
probably waiting to go profitable, as we mentioned. So to give a quick recap of it, it was formed back in 2012, and just think about it as Uber Eats, but for groceries, essentially.
Yeah.
Doing the weekly shop or picking up a few bits. So it's a
Mm.
grocery delivery chain. It's a gig economy based app, essentially. Works with major chains like Kroger, Costco. And depending on where you live, I think this service can seem very unnecessary. Do you know, if you live in
Mm.
a small place and you have a car or whatever, it's like, why would I need that? But it's funny if you're from a big city, high rise apartment with no lift, that kind of stuff, it comes a lot more necessary. And then obviously for older people or people with disabilities, this is pretty much a lifesaver. And we've seen grocery deliveries happen all over the world, but Instacart is kind of building out the platform, we'll say.
Yeah.
Uh,
Yeah.
yeah.
It has echoes, Mike, of a local business here that was acquired recently by an Irish supermarket chain called Dunn Stores, and who you, of course, are familiar with.
Yeah.
And
What
it
was it
had a
called?
mass. It
Buy
was
Me,
called
is it?
Buy Me, Buy Me.
Yeah,
Yeah,
yeah, yeah. I
exactly.
remember that. I think I used it once.
Oh,
That was
so
it.
it had a massive tailwind during coronavirus, like, and
Yeah,
it's
as you can
somewhat,
imagine.
yeah, it's somewhat masked. Let's say normal market conditions. It's very hard to read how good is our business doing when everybody has to stay indoors. How did the coronavirus, if you like, surge affect Instacart's business, and how has it settled back down?
So this is the interesting part, I think, about Instacart is that I think at one point there was a quarter where it was growing 600% year over year over COVID.
Wow.
Yeah. And I think the whole story around Instacart, and this, it's a very important IPO because it's the first venture backed American IPO since December 2021, I think.
Oh, really?
So this
Right.
is very important for the private markets and for venture capitalists and private companies alike, because they're watching to see the reaction on the public markets, how investors are basically treating Instacart to see, well, is it worth for us to IPO?
Mm.
And the story goes, so you're mentioning from COVID and beyond. So Instacart raised money in early 2021 at a $39 billion valuation.
Whoa.
It's trading just around nine, I think a little below nine now.
Right.
So that kind of gives a bit of context into how it's gone. And
Yes.
it wasn't like any chumps that got in at the $39 billion either. It was big names. So Sequoia Capital, Andreessen Horowitz, Fidelity, T. Rowe Price, like big proper
Whoa.
names. And you
Who's
can
who? Yeah.
imagine why. You know, like, as in, it was at the peak of the pandemic. Money was very cheap at the
Mm.
time, anyways.
Mm.
You're getting a company that's growing 600%. Nothing can go wrong. So it was very short termism, I think, but also I'd
Yeah.
nearly like forgive them in a sense.
Yeah.
Um, but yeah,
But
I think.
sorry,
No,
go ahead,
sorry, go
Mike.
on.
But logistically, just if I can just picture the business, do they simply collect the stuff and deliver it, or do they go into the supermarket? Do they go into Walmart and walk down the aisles and put stuff in the basket and make sure you got the green bananas as opposed to the speckledy ones? Like, how deep into the process are they involved?
Yeah, they're the shoppers. You know,
So they are the shoppers as
that's
well.
that's,
So,
that's the gig workers. You know,
mm-hmm, mm-hmm,
So yeah, so like seeing that kind of cut from its previous valuation to now is indicative, I think, of a lot of private market valuations, and I don't think that going from 39 to 9 should put off a lot of investors,
mm,
because most of all, and this is happening with Instacart as well, is employees are mad to get an exit. So this is actually what happened with this IPO, in the sense that only 8% of outstanding shares were floated. And of that 8%, 36% were employees selling off. And there were a
right.
lot of that was in the two founders who aren't leading the company anymore. So it was more a fundraising it wasn't really a fundraising exercise at all.
Yeah, right.
It was just
And I
really
think
to
that,
allow employees get some liquidity, and ensure the employees would prefer to get some liquidity at 39 billion and selling in a private round, but that's just not how it works, I'm afraid.
but that's interesting because when you look at the Klaviyo IPO and Instacart, I think one of the issues we have as retail investors is that after the company IPOs, there's an information lockup period, which is usually between 90 and 180 days, where insiders such as the founders and executives and early investors are prohibited from selling their shares. And the purpose of the information lockup period is to prevent insiders from flooding the market with shares after the IPO, which could, of course, hurt the share price. And the real challenge for you and me and any investor who looks at a business post IPO is that there's not a lot of new information forthcoming. You go to their investor relation website, you go to Instacart IO investor relation web, and it's empty. There's nothing for us to grab onto. If you want to find out the story, you go to the SEC website, and there's incomplete data in FactSet or Yahoo Finance or whatever tool you use to go and inspect a business. And then you kind of, when you get under the hood of the story, you find facts like the one you just made there, Mike, which is really, this was primarily motivated so those who are founders or early investors can get out. And that kind of raises other questions, which you have to wait to see kind of trends and see how, in fact, the business is playing out as a public business.
Yeah, but that employee exit in particular is very important. I think Stripe had a lot of issues with that, where they Stripe essentially screwed the pooch and they missed their opportunity to go public at the right time, and they've
Right.
gotten cut in half in the private market since. But
Yeah.
a lot of their fundraising events and funding rounds were to give employees liquidity now, because I
Yeah.
think employees have been there for so long and they want their payout. Like, it's the reality of it. If you
Yeah.
were employee number 9 in Stripe, you're sitting on millions, if
Oh,
not
yeah.
tens of millions of share
Locked
options.
up.
And
Yeah.
it's great to have that, but you're also, still a salaried employee. You're
That's right.
worth X amount, but you're not able
Yeah.
to spend. You're not able to spend that. And I know you can get loans out against it and stuff, but that's for
Yeah.
the billionaires, not for the
That's
lowly
right.
millionaires at
Yeah.
Stripe.
Yeah.
But
Yeah, that's true. So if
yeah,
you were handed $1,000 tomorrow by your great auntie and said, "Here, invest that for me," would you buy shares in Instacart?
first I'd be shocked. Auntie Bab came back from the dead. um, but it's an interesting conversation, because I think immediately you see the valuation go from 39 billion to 9 billion,
Yeah.
and you think it's a company in decline. And I actually don't really think that's the case. Obviously, it's not growing as fast, but there's
Yeah.
a lot more now compared to 2 years ago within the business. And a lot of it has come from, well, there's two factors. One is that it's actually held on to the market share claim during the pandemic. So, like,
Right. Very important.
you would assume that it would be a big, perfect parabola. Here I am describing a graph now, Emmet. I know that's your thing, but the dip would come after. But it's actually kept a lot of those gains and maintained them. So 74% of sales greater than $75 on a third party grocery delivery app are still Instacart, and 56% of
Interesting.
sales less than 75. Um, and it's done this while turning a profit, which is the important thing. It's what we mentioned. So I think it's 5 consecutive quarters of
Mm.
profitability, which
Mm.
I wouldn't really see. I came into this with kind of an open mind, because I do not like gig economy companies. I don't like their business
Mm.
models per se. But
Mm.
what it's done is it brought in the CEO Fiji Simo. She came from Meta, and basically what she did was she built out the advertising platform. And this was always a tactic from the founder, where they said, once we reach a level of scale, we can build an advertising platform on this. And we've seen this when Amazon is a perfect idea. Like, Amazon is like one of the third or fourth biggest advertisers now, just
Mm.
because the marketplace is there and it's so scalable, and it works. And Instacart has actually achieved this. So I think she came in 2021, and the advertising is making up a third of revenue now and almost the majority of profits. So to kind of tack on this high margin revenue stream has really transformed the business, I'd say. And I think that's why they went public, is because, well, no, we're not just another DoorDash or Uber Eats. We actually have a very functioning business here, and we're profitable, and we're able to bring in that high margin revenue that people are looking for, instead of just the growth that was there for gig economies and probably isn't there anymore. But
So would you drop $1,000 on it?
no, Not
Ah.
not at all. So that I was going
Hmm.
to say that's the good part, but the not so good part. I think
Mm.
in general there's a reason why I don't like gig economy workers, and I think there's no moat there at all.
Yes. Oh, there's none. There's
No.
none. Who's the lift to their Uber, as it were? Who's the second biggest name? Because Instacart is one of just been broadly aware of. Is there a B player?
Yeah, well, DoorDash and Uber Eats
Oh
both.
yeah.
DoorDash and
Right.
Uber Eats both do groceries as well.
Groceries.
But again,
Okay.
do you remember I said, the big shop and the small bits, there's the difference there. So like
Yeah.
orders of over 75, Instacart still has 74% of market share, and it's 56% of the under 75, so the lower bits. But
Yeah.
the big question here, so first of all, Instacart's customer concentration, they have 43% of its volume comes from just three retailers.
All right.
So what happens if one of these businesses decides maybe we launch our own delivery service, or
Hmm.
at the very least, well, we contribute 20% of sales to this company, we can really lean on them and get a discount and all the rest. And like
Hmm.
launching their own delivery service isn't out there at all. Target owns its own, I think it's called Shipped. Amazon has it with Whole Foods. Walmart has its own delivery as well. Kroger has its own delivery service as well. So you're almost, and this is kind of the inverse of what we talked about with Shopify, where with Shopify, it's great that their biggest customer became an investor because they're not competing against them anymore. Whereas
Mm.
now the potential for Instacart's customers to turn into competitors in a second is very, very quick. And in a market or an industry with razor thin margins like groceries and stuff, it just doesn't seem too tenable for me long term. I think
Mm.
every kind of management structure will come in and say, all right, well, how do we cut margins? Where are we spending money? Why are we giving Instacart X amount? Instacart's take rate is like 7%. Let's get it to 4% for us, or we go with another company, or we do it ourselves. And if Kroger or Costco or whoever decides to do it themselves, they could charge no delivery fees because
Mm.
they don't need to make money off the delivery fees. They make money off the products. So yeah,
Hmm.
that would be my big kind of red flag there, where I
I'd,
just
I'd share that concern. I mean, I think most people would say whether they get in an Uber or a Lyft or a free now if you're in Europe is of little consequence to them once they get there safely and the car is clean and the price is broadly acceptable. And it's the same for when you get a delivery. You don't care who does it. You don't care what company did it. And I think when you think of that, there's no endpoint customer loyalty, I believe, unless they have this magnificent technology platform that nobody else can replicate, which of course we both know is not the case. So I'd be with you too. I wouldn't be overly keen on it if I had to choose between the two businesses we just discussed. I would go with Klaviyo or
yeah, me too,
Klaviyo.
for
Mm,
sure. It
mm.
reminds me of this was way back in the prime Uber and Lyft venture capital days, where you'd have both on your phone. You'd use
Yeah,
Uber for a couple of weeks, and then Lyft would
yeah.
realize you haven't used it for a couple of weeks. They'd send you an email, you've got discount for however long. You'd use Lyft, and then Uber would realize you wouldn't have used it for a while, and they'd email you the discount. It was nuts. We were driving around with the personal chauffeur on San Francisco's venture capitalist money. So yeah, but it
Oh,
is true.
interesting. The
Yeah,
war between those two companies is something I'm sure that's been well documented. But there was some very dirty tactics at the time. You might remember where if you cancelled a lift right up until they arrived at your door, there was no fee. And as far as I know, Uber got up to some dirty tactics on that front
yeah.
to kind of fatigue the other player. But anyway, look, we're drifting. Yeah. So Instacart is a thumbs sideways to thumbs down. Is that right?
Tom's pretty down. I think it's done a lot.
Mm.
I think the CEO seems interesting with the advertising and stuff, but yeah, it wouldn't be for me. And as well, they're saying for the first 6 months of 2023, or maybe the most recent quarter, volume is flat year over year. So
Right.
it's
Okay.
also
Not
slowing
great.
down on top of all of that. Apart from the
Yeah.
kind of systemic risks and the no moat we mentioned,
Yeah.
there's also operational risks happening as we see it. So I wouldn't
Yeah.
touch Instacart personally. Klaviyo
Yeah.
does seem interesting. Again, a lot of competitors, but it seems to be doing something right.
True. And I would share your worries though, because all those competitors, they're going to put their best foot forward as they get ready for IPO, and hence swinging from a lossy position to a profitable position. But I would certainly give it a few more quarters before I get too excited about it being a partner of Shopify and it having grown revenue at a very impressive rate. I'd like to see it just continue for 4 more quarters while they exist in the post IPO world.
Yeah. Okay. So neither of us with raging buys from those two, but that's okay. That's how it goes sometimes.
Yep.
All right. So if you are like listening to us, you're going to love reading from us. We are delivering to your inbox one of the most unique products on the market, and it's completely free. No one else is covering the markets we cover with Charging First, where we deliver to you a new weekly stock pitch that could be from Amsterdam, Tokyo, Paris, or somewhere in between. So that's a completely free stock pitch. Every week, you'll have it read in about 30 seconds flat, and we can almost guarantee most of these companies are going to be brand new to you, which is where you get an edge. Sign up now in the show notes for this episode. Emmet, was this week's company new to you?
It was new to me, and in fact, to you, I was just as you were talking there, thinking Charging and Fearless, I believe, delivers the highest level of free value for stock investors that I've ever seen. Now, I am biased, of course, I am, but I think it is an amazing publication. It asks nothing of you except just to sign up. So, yeah, well done. It was a brand new company. Was it new to you as well?
I was very, very familiar with its output. Anyways, I didn't know it was a public company, but yeah.
Okay, right. Yeah, say no more. Let the listeners get intrigued enough to sign up.
All right. Let's finish off with some big deal or no big deal now. Crowdstrike was very busy this week. It had a new acquisition. I think it did another one of its research reports where it got 100% in everything and bet all the competition, and everyone decided it was the best cybersecurity dude in the world. But I want to
Yeah,
talk about its investor event. So I think it's called FAL.con,
yeah.
investor briefing, whatever it is. But basically, it just, to everyone's delight, updated short and medium term targets. So it's committed to GAAP profitability this year. It's upping its EBITDA margin target and its gross margin target. And it also set a long term goal of 10 billion in ARR over the next 5 to 7 years. Big deal or no big deal, Emmet?
It's a big deal, Mike. Definitely, it's a big deal. I mean, as you said, it's going to achieve GAAP profitability this year, increase EBITDA margin from 21 to 30%. That's massive. Increase subscription gross margin target from 79.5% to 83.5%. And as you said, achieve 10 billion in annual recurring revenue in the next 5 to 7 years. I mean, this is an announcement from a business that has such confidence and strength from the quality of their product. It's effectively, to my ears, it's saying that they expect to be the Microsoft of endpoint security and all things cybersecurity. This business has really, really got it right. And I think it's a wonderful business. And like an EBITDA margin of 30% would be very high for cybersecurity company. And it basically says to me that CrowdStrike is an extremely efficient business. And in a world now where every type of business is vulnerable to some kind of crypto attack, casinos in Vegas and TV studios like in the morning show, um, or the Apple's latest show. When you have a big business that has been utterly hijacked, like was it the MGM?
MGM, yeah.
Where even the doors of the rooms wouldn't open.
It sounded like
Every
complete chaos. Can you imagine?
And if you have an exec committee and every member of staff where their personal communications have been compromised, and you bring in that human element, so not only the business element where you have thousands of irate regular customers, your casino floor has sat down, and your private messages are now in the hands of someone, they say, pay us to pick a number, $50 million. When CrowdStrike walk in and go, hey, we can protect you for $5 million a year. It's like, it's like selling, candy to kids. It's just
Yeah.
going to happen. They're going to sell it, especially when their product is proven, and I'm taking their good word for this, as the best. So I think it's a big deal. But what do you think?
Yeah, I'm actually really impressed by the gross margin target. So they're
Yeah,
basically cutting cost of revenue by about 20%,
yeah,
which, it's not that it's not in your control, but it's almost more impressive to me than any of the other stats there, because it just
Yeah,
seems the confidence to say that. First of all, they obviously have a
that's right.
fair idea that it's achievable. But then
Yeah,
imagine if we're talking about grocery stores there, like, as in, imagine if Kroger was like, yeah, we're going to
unbelievable.
cut our cost of revenue by 20% in the next 2-3 years. People will go
Mm.
nuts. And I know it's a different animal
Yeah,
altogether, and we're talking software and everything else. But yeah, and so I've always been impressed by this business, and I think the need is there, obviously, as you mentioned. But how it operates, I really like the CEO George Kurtz.
yeah,
I love when businesses do those kind of long term North Star targets. It's like,
yeah,
yeah, 10 billion in 7 years. We'll probably
yeah.
get there earlier, but everyone is kind of attached to that now. So yeah, I'm very impressed by CrowdStrike.
And when you think of, I know not to overlabor the point, but when you think of the gross margin target of 83.5%, that is so elite. You really only see it in software businesses that have developed something that just isn't available elsewhere, or breakthrough drugs and pharma companies that have basically smashed through and developed something new to cure something horrible. But those type of gross margins are just unbelievable.
Yeah.
So yeah, big fan. Right, Mike, I've one for you. The writer's strike that brought Hollywood to a standstill looks to be up. Big deal or no big deal?
Yeah, big deal if it goes through. It's a funny story to research, because almost every headline has the word tentative
Yeah.
in air quotes, and I'm reading it as they come to a tentative deal. Don't get too excited. It's
Yeah.
tentative so far,
We're nearly friends.
but we're nearly friends, exactly. So I'm not sure how much confidence it inspires, but it should be good news for the studios, of course, but like us, the viewers as well. We haven't really
Yeah.
felt it yet, but the downstream effects of this are kind of, well, you remember, it was a long time ago now. It was maybe 15 years ago. Um, and there's like a list of movies and TV shows that were made awful basically by the last writer's strike. So there was a Daniel Craig James Bond movie, which is like one of the worst James Bonds, that was written during the writer's strike, or wasn't edited because of the writer's strike. Do you remember that,
Oh,
Quantum of
really?
Solace?
No, oh, yeah. Actually, I wasn't aware of that fact. And
Yeah. So it's his only really
I think I
bad one,
liked that movie.
basically. Or do you remember that TV show Heroes?
I'm aware of it. Yeah.
Yeah. So apparently that completely fell off a cliff from like season 1 to 2 or 2 to 3 or something, and that was because of the writer's
Oh,
strike as well.
really?
So they basically made
Oh,
it
interesting.
while writers were striking, and I think they couldn't go back and do edits, or very constricted, and they put out terrible product basically. But to the current writer's strike, so it's been almost 5 months, 146 days, I think they were striking, and the deal, there's no real details that have come out yet. Now, I fear they might come out between recording and publishing this podcast, which usually happens on Stock Club. But for now, they haven't come out. So the deal still needs to be kind of voted on, ratified
Mm,
by its members. But I think there would need to be some serious kind of coup for it to be turned down. Um, we don't know the details, but the three main tenets of the deal were based on protections against AI in writing, which you can imagine writers
mm,
would be vehemently against, residual payments on streaming platforms, and then staffing minimums for writers' rooms. So what was happening a lot with streaming was that, say, a writer's room would go from 10 to 4, and they would only need they just cut costs basically by not hiring enough people, essentially, and that would obviously affect everyone in the industry. So the representatives from the Writers Guild said that, and this sounds a bit like Donald Trump, this deal is exceptional, meaningful gains, protection for writers in every sector of the membership. So
We
we
have
can.
just lost listeners. With one impression, we've lost listeners, and we've gained a few, so that's okay.
so so you can imagine that they've kind of touched on all those three. I've heard that the AI point in particular was their last obstacle. So I'm not sure. Imagine there's a big compromise there for what actually happens. But yeah, that's kind of the
Mm.
gist of it now. Do you remember, this was a couple of weeks ago, Aaron Paul, so Jesse from Breaking Bad,
Oh,
he
yeah.
came out and said that he doesn't receive any residuals from Breaking Bad on Netflix. That kind
Oh, I
of
didn't
took
know that.
me for a shock. So I was
Yeah.
thinking about it, especially in through the guise of the streamers. Um, Maybe everyone but Netflix, because Netflix are very profitable, but all the rest of them are hemorrhaging money and trying to cut down costs and turn their streaming services profitable. So I wonder how much this agreement will eat into their bottom lines, and will it be enough to even raise the question whether they should keep doing it or not? Do you know what I mean? Like
Mm,
Apple TV
yeah.
or Amazon Prime, who are burning cash. Disney Plus is burning cash, and they're like, well, now we've got all these additional costs as well. So how does that affect things? So I'm
Mm,
curious what the long term effects will be for this, and Netflix too. You know, this has to affect profitability in some way, because they've just added basically a new line item
mm.
of costs. So
Yeah, yeah.
yeah,
And it's funny when you think about the inevitability of the application of AI into any thought-led profession. Um, you have to wonder, are those writers committed to not using AI on the QT at home when they're writing up a new script? I don't believe for a minute they're not. So, you're kind of opposed to a technology uh,
but
disrupting you or moving your cheese when in fact there's probably a high degree of certainty they're using it on the
yeah,
burner
well,
laptop.
there's a lack of understanding as well. Remember, the actors are still striking, so I know they started striking in sympathy with the writers, but they
Mm,
haven't come to an agreement yet. I think a lot of the stuff was very similar, so I
mm,
imagine they'll follow suit. But I think actors were very wary about AI being used to like recreate likenesses and stuff,
yeah,
and whether they
yeah.
would own the rights to their own face nearly in
Mm,
certain
mm,
situations. And like it's weird to think about, they're striking against something that no one really knows how it's going to be applied yet. They just know it's the kind of boogeyman in the room a bit, you know.
mm, mm, mm. Yeah, I was it Bruce Willis who recently was the first actor to sign a deal to say that his face is going to be used in a movie and his likeness and it's going to be generated with AI. So it's
Really.
kind of showing, oh yeah, so I think there's the thin end of the wedge is there already. But for me as a just a human being, when I realize or I'm told that something was generated with AI, no matter how impressive it is as a product, I devalue it. So if
100%.
someone said this piece of art was done by artificial or generative AI, I go, okay, fine. Well, what is the purpose of art? Well, as far as I know, it's to show you something that otherwise you wouldn't have seen, or to show you something in a light that otherwise you wouldn't have seen it in that light. So that's its purpose. But the fact that it's human created um, brings a far, far deeper meaning. And when you apply that to writing, or you apply that to anything that is human brain led, you kind of, for me, AI, as much as it bolsters it, if it's something to be admired and absorbed, it is devalued when you realize it's AI. And that's just my kind of feeling on the subject, but that doesn't mean it's going to stop it.
Oh, that's a fact for sure. Like, 'cause then if you're ever
Mm.
reading something, you can tell when it's not human written, or if that even
Yeah.
feeling if that feeling even creeps up on you, you look out for it then as well. And it
Yeah.
completely agree, it devalues it.
I'm a huge Queen fan, as you well know, and TikTok identified this and started to give me songs by the Beatles sung by Freddie Mercury. So it gave me a version of Imagine sung by an AI Freddie Mercury, a magnificent song sung by a magnificent singer. But it was all wrong. It didn't work for me. The fact that it wasn't Freddie Mercury and the fact that and it wasn't John Lennon, it just was broken. It was like interesting. I looked at it and went, "That's interesting," but it didn't have that deep emotional root that goes back to for people standing in studio recording either Imagine or Don't Stop Me Now. And that kind of is for me like where AI just kind of breaks the magic.
Yeah, yeah, it's scary what's on the horizon. I think when it comes
Mm.
to entertainment and stuff, I really don't know what'll happen, but we will see. Okay, before we finish up the show, I just want to give a quick word to our friends and sponsors at Vodafone Business. They recently launched their VHub digital advisory service, offering Irish business of all sizes free one-to-one digital support and advice. You don't even have to be a Vodafone Business customer to avail of this service. Just search Vodafone VHub to book a call with one of their digital experts, and we will leave a link in the show notes for today's episode. All right, that's it for today's show, Emmet. Thank you for joining me, and thanks everyone for listening in. If you have any questions you'd like answered or elevator pitches you'd like us to tackle, make sure to get in touch. You can find us on Twitter at MyWallStreetHQ, on TikTok at MyWallStreet, or simply just email us at pod@MyWallStreet.com. If you're enjoying the show, leave a review or send us on to some of your friends. Thanks for joining us, and we will talk to you next week.